Hi, I'm Isaac. Today we are looking at IAS 17, which is on leasing. So leases. Today we'll look at what leases are. We'll try to explain the different types of leases, and then we'll also try to show the accounting treatment of each of the various classes of leases. Now let's first answer the question, what is a lease? Now, a lease essentially has to do with having the use of another party's assets, where the party is called the lessor, having the use of the lessor's assets in return for rent. So with a lease, somebody has an asset, right? The person who has the asset is called the lessor. Then another person comes in and have the use of that. That person is called lessee, and the lessee pays rent. Actually, it is a periodic rent which is payable to the lessor, right? So that is how leases work. So when it comes to leases, there are certain few terms that we need to explain. One is called the lease term, which is the time period within which the lease agreement is operational. So this could be 2 years, it could be 3 years, it could be 4 years, depending on the particular type of agreement that is written between the lessee and then the lessor. There is also what we call the minimum lease payments. Now the way leases work, normally the lessee is going to pay periodic rentals to the lessor, right? So the minimum lease payment basically has to do with the total payments that will be made under the lease. Assuming that we have a lease which has an initial deposit, so you make an initial deposit of, let's say, 50,000, right? Maybe you are acquiring a plant on a lease basis. So you make an initial deposit of 50,000, followed by a 4-year annual installments of, let's say, 40,000, right? Annual installments of 40,000. What it means is that you are going to pay 40,000 every year for the next 4 years, giving you 160,000. Then you are going to pay an initial deposits of 50,000. When you put these two together, that gives you 210,000. So in a simple situation like this, the minimum lease payment is going to be 210,000. That is the total amount you'll be paying under the lease. Now, in a more complex situation, certain other amounts like option fees, which represents the amount you pay in a bid to own the assets at the end of the lease term, right, would be added to the minimum lease period. Sometimes there's also what we call guarantee fees, so the lessee will guarantee the lessor a minimum amount of residual value for the asset. All that are added to the minimum lease payments. Now let's come on to the various types of leases. Essentially, there are two types of leases. There is what we call finance lease, and then there is an operating lease. Let's look at each one of these in terms. So let's look at finance lease. Now, by definition, we normally say that a finance lease is a lease that transfers substantially the risks and reward incident in the ownership of the assets. There are two things there: risks and reward. The assets that is being leased may come with a risk. It may come with some losses. Those losses will be borne by the lessee. It may also come with some benefits, some reward. Those benefits and reward will be enjoyed by the lessee. If that is a kind of agreement that is signed, then the lease agreement is called a finance lease. Normally, we say that any other type of lease is an operating lease. So any other type of lease other than a finance lease is what? It's an operating lease. So the question is, how do you identify a finance lease? What are the conditions that makes you identify a finance lease? The following conditions normally helps us in telling whether we are dealing with a finance lease. One is that ownership of the assets should be transferred to the lessee after the lease term. Then two, the lessee must have the option to own. So the lessee should have the option to purchase the assets at the end of the lease term at a value which is sufficiently lower, than the fair value at the time. So at the time the option becomes exercisable, and that at the inception of the lease it is reasonably certain that this option will be exercised. So 3, the lease term. So here we are talking the lease term is for a major part of the economic life of the assets, even if title is not transferred. So for instance, assuming that the economic life or the useful life of the assets, it's, let's say, 10 years, and you are taking a lease on this asset for 9 years. It means that the lease term, which is 9 years, forms a major part of the useful life of 10 years for the particular asset. If that is the situation, then the lease in question will be a finance lease. So 4, at the inception of the lease, the present value. So at the inception of the lease, the present value of the minimum lease payments amounts to at least substantially all of the fair value of the lease assets. Now what this means is that, let's assume you have calculated at the beginning of the lease, at the inception of the lease, you calculated the present value of the minimum lease payments, and you had a value of, let's say, 9,950. Then you determine the fair value of the assets also at the inception of the lease, and the value you had is about 10,000 cedis, right? So if you look at 9,950 and you compare it with 10,000 fair value, the values are not significantly different. So if this is the situation of the lease, then this lease will be considered a finance lease. 5. The lease asset is of a specialized nature, such that only the lessee can use it without major modification being made to it. Other conditions that also give an indication that we are dealing with a finance lease is 1, if the lessee is entitled to cancel the lease, the lease's losses associated with the cancellation would be borne by the lessee. Then 2, the lessee has the ability to continue to lease the asset for a secondary period at a rent that is substantially lower than the... Alright, let's look at the accounting treatment. We'll first start with an operating lease. Operating lease. Because this is quite straightforward. With operating lease, what we do is that the lease rentals, the annual lease rentals, is written off as an expense to the income statement in the year when it is incurred. So normally the total amount of the lease agreed upon would have to be recognized in the income statement on a particular basis, normally a straight line basis, and it is written off to the P&L. Let's assume that the agreement is that under our lease, we are going to pay 50,000 every year. Since it is 50,000 every year for 5 years, right? So ordinarily, that 50,000 every year that has been incurred will be written off to the P&L. It just happens that sometimes the annual payments may not necessarily be constant. It may not necessarily be, say, 50,000. Probably in a year is 50,000, the following year 40,000, it could be 30,000. The amount could be fluctuating. We would have to use a particular approach that would represent the benefits we are receiving from the lease. And normally we use a straight line approach. So assuming that in year 1, I'm paying 50,000, in year 2, I'm paying 40,000, in year 3, I'm paying 60,000, in year 4, I'm paying, let's say 50,000. That means that the total amount I'll be paying over the 4-year period is about 200,000. So ordinarily, since this is a 4-year lease, we'll just divide this by that and use an average amount of 50,000, meaning that we'll be writing off 50,000 every year to the debit of our income statement. Now let's look at the treatment of finance lease. Now when it comes to finance lease, initially we would have to recognize the finance lease as an asset and also as a liability. What essentially this means is that we are going to capitalize the asset as though it's one of the assets owned by the company. Essentially, we are going to show it as a leasehold asset. So if it is a plant we acquire on a lease basis, then we'll call it leasehold plant. Now we are going to capitalize the assets, and the amount will also be provided as a liability because, of course, we've not paid in full for it yet. The question is, how much should we capitalize? The amount to capitalize depends on two different values. The first value is the fair value of the asset in question. So if you were buying the asset outright on the market at the time when you went into the lease agreement, on the market, how much would you get this asset for? That is the fair value. So without be given the fair value, in a typical question you will see the examiner will provide the value for the fair value. Then we'd also have to calculate what we call the present value of the minimum lease payments. We'll have to calculate the present value of the minimum lease payment. In our previous tutorials, we saw what the minimum lease payments are. Now, the minimum lease payment basically represents the total sum that the lessee will be paying under the lease agreement to the lessor. Essentially, this includes the amount you make initially, so the initial deposit, if any. It includes the various installments. So assuming you are going to do about 5 installments, then the sum of all the amount to be paying on the installments will be included. It includes what we sometimes call option fees. You know, sometimes it happens that the lessee would exercise an option to own the assets at the end of the lease agreement. So how much is he paying to own the assets at the end of the lease agreement? Sometimes there's what we call guaranteed residual value, which is the minimum value that the lessee will assure the lessor of in the event of the lease coming to an end, for the asset. So all these amounts will be put together, and that is what we call the minimum lease payment. Now, since these amounts are going to be paid in the future, we would want to calculate the present value for this minimum lease payments. Of course, we would want to account for the time value of money, because we know that when it comes to payments in the future, amounts payable in the future do not have the same value as amounts payable now. So essentially, we are going to calculate the present value of the minimum lease payments. Now, what do we do? Once we calculate these two values, the fair value and the present value of the minimum lease payment, we are going to look out for the lower of the two. So, if present value of minimum lease payment is, say, 50,000, and the fair value is say 55,000. Then of the two, which one is lower? The present value is lower, so we would calculate or we'll pick the present value of the minimum lease payments as the amount to capitalize. If on the other way around, the fair value is lower than the present value of the minimum lease payments, then again we would have to capitalize the fair value. So two values are required: the fair value of the assets, and then we would also have to calculate the present value of the minimum lease payment. The lower of these two values is what we are going to capitalize. Now, once we have capitalized an amount, once we know the cost to be brought into our books, right? Of course, it means that we are going to debit our PP&E with that amount. Then we will also create a liability for the same value. Once this is done, an asset has been created. So if an asset is created, the question is the asset a depreciable asset? If the asset is depreciable, then the question that flows next is how long should we depreciate the leased assets? How long are we going to depreciate it? The answer to how long we will depreciate this asset also depends on two situations. Now, the first thing we have to ask ourselves is, what is the intention of the lessee? Does the lessee intend to own the asset? Is there reasonable certainty that at the end of the lease period, the lessee is going to have ownership to the asset? If the answer is yes, if the lessee will, so let's say, lessee will own the assets at the end of the lease period, if the answer is yes, then use the depreciation policy. The depreciation policy of the business to apply on the assets that is being leased. So for instance, if it is a policy of the company to say depreciate asset of this kind at the rate of say over 4 years, then if we have a reasonable certainty that the lessee is going to own this asset, we will depreciate it over 4 years. Now, assuming that we don't have that certainty as to the lessee owning the asset, so it means that the lessee may not own the asset at the end of the lease term. If that is the case, we are going to look out for two things again. So, lessee, let's say lessee will not own the assets. If that is the case, there are two things we are going to look out for. What we'll be looking out for is the shorter. We are going to look out for the shorter of two periods. The shorter of one, the lease term, and then two, the useful life of the assets. And the useful life of the assets is what brings about the depreciation policy for the business. So where the lessee will not own the assets at the end of its useful, at the end of the lease term, then it means that we either have to use the shorter of the lease term or the useful life of the assets, which is also referred to as the depreciation policy of the company. Now, this is very important because if eventually the asset is not going to be owned by the lessee, then there is no reason why you should use the useful life, assuming it is longer than the lease term. So if you have a useful life of 5 years and you just lease the assets for 4 years, it means that at the end of the 4th year, the lessor is going to take back his asset. So in the 5th year, you wouldn't have any assets to depreciate. In the other way around, assuming that the useful life of the asset is 3 years and you have leased the asset for 4 or 5 years, I don't know why you would do that, but assuming you did that, right, then it means that by the end of the 3rd year, from your policy, the company would have fully depreciated the asset. So the assets will not be in use. So in the 4th year and the 5th year, effectively there is no assets to depreciate. So if the lessee will not own the assets at the end of the lease term, then look out for the shorter of the lease term or the useful life of the assets. Now let's look at how these things are computed using some few illustrations.